Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. What do the latest GDP and unemployment numbers mean for investors and for the stock market going forward? Those are just a couple of the issues facing investors this week and issues that we hope to sort out for you here on this edition of the Roundtable. Joining me in the conversation, as always, Steve Reitmeister. Steve is our editor-at-large at Zacks.com. And, of course, the maestro himself, Kevin Matris. Kevin is always on hand to chime in on these conversations. No Charles this week, and we apologize for that, but he should join us on the next installment. So, Kevin, let's start with you. The economy was boosted by $90 billion worth of stimulus, and it is said to have grown at a faster pace in the spring, but not as strongly as expected. Right. Basically, that sums up the latest GDP numbers that came out.
Right.
So what does this mean now here going forward? Apparently, everybody is accepting the fact that we're in a recession.
Maybe not everybody.
Okay.
Well, let's look at it. The second quarter GDP, it came out at 1.9%. And in and of itself, I mean, that is a halfway decent reading. But it was viewed as a bit of a disappointment because the expectation was for 2.4%.
Right.
I think the expectations were so large because we had the stimulus package. In the second quarter, people were receiving their stimulus checks and running out and spending them. And I think that the 2.4% was all predicated on this big boost to the economy. And I think the stimulus did add a good deal to the economy. But the one thing that wasn't anticipated is we saw this big increase in oil during the second quarter. We saw a $20 increase in oil, and if I can borrow a statistic that Steve has said here in previous roundtables, is the statistic is that for every $1 increase in oil, that is equivalent to an $8 billion tax on the economy. So during the second quarter, we saw more than a $20 increase in oil, which is 8 billion times 20. That's a $160 billion burden on the economy. So seeing the GDP in Q2 grow by 1.9%, I think it shows the resiliency of the economy, and I think by and large it's a halfway decent number. But now let's look forward. Seeing the price of oil go down more than $20, now there is a $160 billion burden being removed from the economy. And some may say, I'm one of those people, some may say that that now we have $160 billion removed from the economy, it's less of a burden, and this could be a bigger second stimulus package. So that is what I believe is going to happen moving forward. And what's interesting is that I think that you're going to see people raising their expectations for the third quarter, or at least start increasing the estimates for what we're going to be seeing coming down the pike. I know there's some hand-wringing that the third quarter is going to be weak and the fourth quarter is going to be even worse, but I think that that moving forward with the price of oil, assuming it keeps going down, I think that could bode well.
What about this thought, though? The official organization that puts the official, start and end time on recessions has not officially marked the beginning of the recession yet. But a lot of analysts on the street think it's already started and it did back in the fall, so we're closer to the end than the beginning.
Well, one of the things is they revised the fourth quarter of 2007 numbers, and now that is in negative territory. And so if they're going to mark the beginning of a recession, it should be from that time period. And I'm sorry, I'm just going to say that I think it's been fairly clear that we've been in a recession for a while. Some of these numbers are complete garbage in this second quarter report. I have no doubt that it will be extremely different by the time when we flash forward 6 months and they get this number right. What they're saying, it's almost ridiculous. I'm almost outraged. Okay, what they are saying is that the economy grew by 3%, and then subtract 1.1% for inflation equals 1.9%. Is anyone going to tell me that inflation is 1.1%? I mean, come on.
Right.
Okay, that's absolutely outrageous. Okay, so in other words, the way we come up with the GDP numbers, subtract out inflation, we all know it's at least 3%. Okay, and how do they use a 1.1 number?
Right.
Come on. Okay, I don't know. Is that an election year re-engineering the numbers? It's just ridiculous to me. Right. So the thing is that the fourth quarter of last year was negative. Probably the first quarter will continue to move towards negative. So there's your recession. It's been very clear for a while. And I'd say that it's scary how poor the second quarter is with the stimulus that was in there. And Kevin made a good point about the oil prices kind of dragging things down a little bit true. And also, people don't just run out and spend the check, 100% of the check immediately, and some of that benefit will be in this quarter. But the economy has been in recession since the fall, very clearly. The average length is about 10 months, and I think we're due for at least 10 months, if not longer, given the real estate bubble and the financial crisis. We're probably dealing with a recession that's not very deep, but maybe very broad.
Right. And so that's how investors should be perceiving this.
Well, I think that's one of the biggest things. If you look at the past 10 recessions since World War II, the average is about 10 months. So if, in fact, they revise fourth quarter GDP to a negative number, minus 0.2 or 0.02, so they stripped out 0.06% of growth out of that number. And yeah, who knows? If they're going to figure out a way to strip out 0.09% out of the first quarter, so be it. If they're going to revise this into a statistical recession, that's the way we are, or that's where we'll be. But even though there is still some debate over recession, the fact of the matter is this is a terrible economy. Yeah. It has been extremely difficult. But yeah, if in fact they decide to peg the start of the recession to the beginning of the fourth quarter, that puts us at the beginning of October. The 10th month, we just completed that. That was in July. So hopefully this could be the end of this so-called recession that we have seemingly gotten ourselves into.
Well, let's add into this mix now the latest unemployment numbers that came out. A week ago, employers trimmed the payrolls for the 7th straight month in July. The jobless rate rose to 5.7%, full percentage point higher than a year ago. How does that alter the picture?
I'm going to repeat some things that we've gone over here in the past. First off is that unemployment is a lagging indicator, meaning when the economy starts to go sour, it's one of the last indications that clearly states what's going on. So in other words, that was one of the last things to move after earnings had started to disappoint a little bit and after you see some lower GDP numbers. So now unemployment's on the move, okay? It's gone from 4.4%, now we're at 5.7%. One of the statistics that I'll throw out there is that every time the unemployment rate has moved by 0.4%, that has been a clear indication that the trend has changed. So therefore, once we went from 4.4 to 4.8%, the unemployment rate had obviously started to make a move, and the average move when it starts to do that is 2.4%, meaning that moving to 6.8% would not be unreasonable given the average movement on unemployment. And so I've seen some economists putting out that that's about what they're expecting in this move. So we got another 1.1 to go. Right. The thing is, as an investor, don't wait for the unemployment report to start getting better before you start thinking the economy is going to be better, because it's a lagging indicator. So the thing is, yeah, it looks pretty bad, as well it should at this point of the game. But the thing is, the economy will start rebounding, and corporate profits will start to rebound before that unemployment rate starts to come down again. So we probably got at least another point to go on this one. And in a way, I wouldn't read it too much. I'd pay attention to the other indicators that are more forward-looking, or the indicators that come up first. Right. And so, I would look for GDP, I would look for consumer spending, and I would look for corporate profits to start taking an uptick. Those would be the ones.
Right. What kind of a drag does this news, you think, put on the stock market here going forward now? Any?
You mean the GDP or employment?
Both of them, actually.
Well, it's funny because what Steve had said, it absolutely correct. If you were to look at the recession of 2001 and 2002, I think we saw the unemployment rate get as high as between 5.7 and 6%. But once we were out of this recession, 2003, we saw the stock market really make a spectacular increase. The unemployment rate continued to tick up. I think it got as high as like 6.5%. So yeah, that is a backward-looking indicator. The GDP kind of still backward-looking, but you're going to want to look at what corporate profits are going to be to give you a sense as to what's coming down the pike.
What I'll say is that here, using this 10-month number, we're pretty much at about 10 months into what should be labeled a recession. And yet what I said earlier is that I think this is a shallow recession, but it's a long one.
Right.
Now, so the question is how much longer? And right now, you're not seeing, here again, too many things that give you positive indication that there's any turning of the tide. So right now, I think we are hitting probably the worst of it. Right now, I think so. Even with the stimulus checks, you just feel it on the streets when you're at parties and you're talking to friends, and everyone's talking about it, and it's in the papers. And so now, hopefully, we should be at the worst point. And so it might be first quarter 2009, it might be second quarter 2009 when the economy really starts to turn up. But since the stock market usually moves about 4 months in advance of that, so therefore, looking towards the end of this year as being when the stock market might start to make a positive move, that's not too outrageous.
All right. The one thing I'll leave it there, though. Okay. Quickly, you want to make a quick point?
I was just going to say that the only bright spot is that the rate of jobs being lost has seemingly started to slow down. So if you're going to try to infer some kind of positivity, that would be it.
All right. And you heard it here first. Just remember that. The opinions expressed are those of the participants. They do not necessarily reflect the opinions of Zacks Investment Research, its subsidiaries, or affiliates. And with everybody here at the round table, Steve and Kevin, I'm Terry Ruffalo.